Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Carry trade. There's no doubt that the U.S. dollar is the carry trade currency from an interest rates perspective at the moment. On the front end of the curve, 0.1%. Even if you go out 1 year and you look at the yield, when I say the yield curve, look at the yield, official government yield curve of the U.S. on all the different time frames from left to right, and interest rates generally rise. If you go out to 1 year, the U.S. interest rate is 0.3%. It's right now the U.S. on the low end, on the front end of the curve, as it's called, meaning the 3 and 6 month rates, are lower than any other country in the world, even below Japan, if you can believe that. Beyond that, it quickly starts to get above Japan, but that low front end yield is really part of this process of the government using the dollar as the explicit funding currency for the globe. They're basically giving banks letting banks borrow at 0% interest and then turn around and reinvest and buy more of the government's treasuries, on the long end at 3%. So the banks have a built-in profit, risk-free profit. That's part of the reasons why the money's staying in the banking system and not getting to the real economy. That's another story. But in general, the dollar is the carry trade. If you can borrow at 0%, or if you're an institution, we can't do that, but institutions do it and make those leverage bets moving offshore into Australian dollar and other risky asset areas, or Brazil. You notice that Brazil has put up capital controls. The money's pouring in so fast because of these yield differentials, as I said. Brazil's trying to slow it down. They put in a tax, and they may add more capital controls. It's because of this. The front end of the U.S. dollar is so low, they're making that trade. Consensus is the dollar makes a new low, and the new low measured by the U.S. dollar index is around 70. We're trading around 76 today. That 75, 76 level is an important level for the U.S. dollar index. Below there, it doesn't have much support down to 70. So it's a technical level people are watching. It bounced today, and I think it may have even put in a key day reversal. Let's see. John Ross and I were talking about this morning. It actually did. Right now it's at 75, 78. A key day reversal day for the dollar index was 75, 76. So this could be a decent day that shows a real bounce here. But the consensus is the U.S. dollar goes lower and beyond, and it's still in a major bear market. And it sure looks it. But we've had this before. If you go back and look at 1992 to 2002, the dollar was in a 10-year bull market. From 1992, it rallied sharply and then came back in 1994 and retraced about 75, 80% of that move, and people thought, well, the bear market's still in play. This move, if it doesn't make a new low, looks very, very similar to that period in 1992 to 1994 when people were fooled and the dollar took off again and rallied sharply. So it's something. So that's part of our plausible scenario, a very similar technical, long-term technical pattern that fools people. Remember what I said when I drew that chart? You have that move, then you have this move that say, well, it's still in a bear market, and then you get this. And that's what happened in 92 to 94, and right now we're here. We're right here. It's made that initial move off the bottom, and we've retraced over 68%, so right in the 75% area. So if it stays right in here and holds and rallies back up, it's a little bit of deja vu from a pattern basis. We do watch patterns too. There's a belief in the world by a lot of major economists, and there are only a few that dispute this, and they happen to be the ones that I like, that the U.S. needs to have a very low interest rate to rebalance the dollar to support our trade and rebalance the globe. The reality is, if you look at a country like Australia, they're doing pretty well on trade, even though their currency is pretty high. Germany has always done pretty well with a high currency on trade. So a low currency in trade is not the only factor. In fact, it's really not the most important factor. There's a lot more goes into it than just a low currency. I think it's very sad to think you have to debase your currency and basically reduce the purchasing power of your entire population to try and solve your trade problems. That's just very short-term thinking. Who's very good on this is David Malpass, and David Malpass was a chief economist at Bear Stearns, and I think he's one of the best economists out there. He's a real-world guy that understands small business and understands the economy in a way that most of these bookworms don't. And Malpass makes a very passionate plea that it's about capital investment, and if you constantly cheapen your currency from a policy standpoint, you're chasing capital offshore and away from your country. And a country needs capital to rebuild its base and create, advanced technology and equipment. So that's why he's very concerned, and I very much agree with him. But anyway. The reality is those that are in charge, the powers that be, definitely believe that the U.S. dollar falling is something that will increase U.S. trade and will support global rebalancing. If you look at the current account or look at the trade deficit, it's increased from 2002 all the way down in a very, very big way. The dollar's in a massive bear market. So the dollar massive bear market has not helped our trade deficit whatsoever in the current era in which capital has been forced out so much. So this is very much a canard, but unfortunately that is what's in play, and we have to accept that as the policy tool which pressures the dollar lower. So the action is, we really have to stay with the trend here until we can see some signs of it changing or our plausible scenario starts to play out. And with this trend, the best plays are really, being long the COMDOLs, commodity dollars, two words. That's a fancy name that foreign exchange people have created to sound really smart. Commodity dollars, Australian dollar, New Zealand dollar, those types of things. They're commodity dollars, Canadian dollar, commodity dollars. If this stays in play and we continue to fund the global economy, asset markets are boosted up, China continues to keep the music playing, commodities are in demand, and that's why you've seen the Australian dollar and New Zealand dollar with their yield and growth move the most. Why the euro in this environment or this current consensus? The euro is just simply the flip side of the U.S. dollar. It's the mirror image. It's really the alternative competing currency in a way. It's not going to replace the dollar for a lot of reasons we don't have time to go into, but it's the competing player now because it's the second deepest capital markets in a very developed economies that have solid monetary policy. So it plays that role. Just pure dollar weakness, it doesn't really matter if what's going on in Europe, it's going to play that mirror image role. So if this is the consensus and it stays in play, those are probably the currencies we want to stay with. And we'll show you some charts in a minute. Current scenario, as I said, the dollar is the funding currency. It's falling on low yield and low U.S. growth relative to its competitors. The Fed just came out and announced it's going to keep rates low forever and continue to use it as a funding currency. How can you see this U.S. dollar as a funding currency? Where does it show up? You can actually see it very easily in the charts with these very tight correlations between the asset classes. Let me go through this quickly. This is a daily chart, and this purple line is the U.S. dollar. And as you can see, we came up and we made a high in here of around 90 on the U.S. dollar index, the credit crunch, post-credit crunch high, and then green shoots, and those dollars started down, down, down. And sure enough, below, let's do this one first. This is the S&P 500, pretty much matched with the high in the U.S. dollar. As the U.S. dollar started to come down, driving up the S&P, very tight correlation, funding all these markets. Down here, same thing. The green line is the emerging markets index, and the red line is the commodities index, the CRB. Draw a straight line down through. Dollar peaked, started down, funding the asset classes. So if this stays in play and the dollar moves, what would you expect? These guys down, S&P down. Correlations are very tight because this is very much a credit-driven move as opposed to a fundamentally driven move of late. And I think you can say from 2002 on, the reason these correlations have been so tight is because of the massive amount of dollar credit created by those trillions of dollars in derivatives.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.